Today we're going to be talking about the 4 key concepts and terms you need to know when analyzing commercial real estate properties. Understanding how these 4 work together is super important when searching for your next commercial investment property. Keep watching till the end so you can see how much of an impact the cap rate and creditworthiness of your tenant impacts the sales price. I'm Nate Ulrich. I'm a commercial broker in Omaha, Nebraska. Let's jump on my computer so we can see how all 4 of these work together.
The 4 terms we're going to be doing a deep dive on today are NOI, or net operating income, cash flow, cash on cash return, and cap rate or capitalization rate. Net operating income, what does that mean? Well, net means the result after something was taken away or added. Operating income is the money that is coming in that is produced by your asset. So basically for triple net properties, it's the rent, that's your income, and there are very few expenses. If it was a multifamily or residential property, there would be taxes, insurance, those would be expenses you'd want to calculate in. For our examples today, we'll be doing a triple net leased property. So the net operating income is purely going to be the rent that the tenant is paying in. This is the income minus expenses for your property. Next, we have cash flow. Cash flow is simply the net operating income of a property minus the annual debt service. The annual debt service is how much principal and interest you are paying the bank for the loan that you've gotten to purchase this property. The cash on cash return is simply the cash flow divided by the down payment. For today's examples, we're going to be using a 30% down payment, so you will be borrowing 70% of the purchase price from the bank, and you'll be paying on that monthly. Lastly, the cap rate or capitalization rate is simply the NOI divided by the price paid for the investment property. Now, what do we have to watch out for to make sure that our commercial investment property is a good one? Here are just some basic rules of thumb. Obviously, on the NOI, you want your income to be greater than your expenses. If it costs more to own this property than the rent or the income that it's bringing in, it's not a good deal. Similar situation for cash flow. You want your NOI to be greater than your annual debt service. The reason for this is if your NOI isn't greater, you're going to have to be throwing in extra money every month just to pay the mortgage. This is not a profitable investment property. Cash on cash return, this varies from investor to investor. Some people are happy with 6% cash on cash return. Some people say, oh, in my market, I'm only happy with a 26% return. Some of this is also market dependent and what's available. What's a good cap rate? This is also very investor dependent. Some people can be happy with a 6 cap. Other people might want 8 or greater. The thing to keep in mind is cap rate is a 1-year snapshot of how that property is going to perform. So if initially the calculations put the property at a 6 cap, but there are rental increases or there's going to be tenant turnover where you can re-tenant the property, it's going to cost you some probably TI allowance and leasing commissions, but you can put a tenant in there that pays more rent. That cap rate of 6 in the first year goes away and the property can be much more valuable. So keep that in mind, that the cap rate is just a 1-year snapshot of how it's going to perform. And if there's rental increases or opportunities to re-tenant the building with someone who's going to pay higher rent, that is what you want to be looking at when you are thinking about if this is a good investment or not. Let's take a look at our first example to see how all of these 4 concepts work together to understand an analysis of a commercial investment property. For our first example, let's say that we're looking at a Kentucky Fried Chicken with a purchase price of $1 million, a down payment of 30% of that price or $300,000, and your annual debt service is $49,000. Now we'll calculate the NOI. Remember, this is the income the property generates minus the expenses. In this situation, we're going to say that this is a triple net lease. So the amount of rent that KFC is going to be paying is $60,000 minus the expenses, no expenses because it's triple net, So it's simply $60,000 for the NOI. Now cash flow. We're going to take that NOI and minus the annual debt service, which is $49,000. So we have $60,000 minus $49,000. Cash flow annually is $11,000. To get the cash on cash return, we're going to take that $11,000 and divide it by the down payment for our loan. And remember, we put 30% down for this $1 million restaurant, so that's $300,000 is 30% of that. That makes the cash on cash return 3.6%. Now we'll calculate the cap rate for this building, which is the NOI, which is $60,000 divided by the purchase price, which was $1 million. That is going to equal 0.06 or a 6% cap rate. Now for our second example, we're going to do Nebraska Fried Chicken, which is a lesser known restaurant, only a few locations, but they're just starting to get big. Due to not being as well known, the purchase price for this one is going to be a little less. It's going to be $700,000. The down payment, 30% of $700,000, is going to be $233,000. And your annual debt service on the remaining, the 70% of $700,000 is going to be $33,000 a year. And that would make sense compared to the more expensive KFC, where it was $49,000 because you're paying on $700,000. Here you're paying on about $467,000. The rent, which we'll say is the same, it's going to be $60,000 minus 0, or $60,000 because it's a triple net lease. The cash flow, as we'll see, is going to be a little different because the debt service is significantly lower for the Nebraska Fried Chicken. It is $60,000 minus $33,000, which equals $27,000 cash flow annually. The cash on cash return, therefore, would then be the $27,000 divided by your down payment. Here the down payment's a little less because the purchase price was less, divided by $233,000. This should be higher, obviously, because the cash flow is a lot higher when compared to the Kentucky Fried Chicken. This is 11.6%. That's more like it. And now the cap rate is the NOI divided by the price or the value. The NOI is $60,000 divided by the price, $700,000, and that is going to equal 8.6 cap rate. As you can see, with a comparison of these two restaurants with the same NOI, the KFC, which has more locations, has better credit, it's a national tenant, the cap rate will be lower, which therefore raises the price up to $1 million, where the Nebraska Fried Chicken, same NOI, the cap rate is going to be higher because there's more risk, and that equates to a lower price. The purpose of these two examples is to compare two similar restaurants, one more of a national chain, one more of a mom and pop shop. The NOI is the exact same, $60,000 a year, but with the KFC, you get the higher asking price because the cap rate for those properties is generally lower. For the NFC, the cap rate is going to be higher, which means a lower purchase price, but it's also going to mean more risk. The purpose of comparing these two restaurants with the same NOI is just to show that with a national tenant that has more credit than a mom and pop shop, the cap rate is going to be lower, which means the price will be higher. That's the KFC situation. For the Nebraska Fried Chicken, or NFC, the cap rate is going to be higher because there's more risk, and the purchase price will be lower. Thank you everybody for watching. Don't forget to like and subscribe. Let me know in the comments below if you have additional questions. We'll see you next time.